Following the calculation of value at risk for a single position in the previous episode, today I continue with our journey and now start to look at the value at risk calculation for two positions. This is a critical stepping stone to understand before we move on to looking at full portfolio risk management techniques, which can have a dramatic effect on trading. Stay tuned. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. As a trader, you'll benefit from cost-effective market access via multiple trading platforms and APIs. These enable trading and investing in any US stock, over 60 of the most liquid futures contracts, FX and CFDs. You can even diversify your portfolio by buying and selling other traders' strategies as investable assets themselves. So, if all of that sounds interesting, learn more by clicking on the link top right now or find further links in the description right below. Now back to today's tutorial. Calculating the value at risk for two positions requires us to be able to calculate what's called the Portfolio Standard Deviation. And in turn, to do this, we have to be able to calculate the correlation between positions. All will be explained. Let's take a look. Before we get into the calculations, I thought it would be worth reminding ourselves about why it can be so beneficial to measure and manage portfolio risk. And in previous episodes in the series, I provided this illustration. The chart on the left is for a particular trading strategy that trades multiple assets simultaneously, a maximum of 28 forex currency pairs in this particular case, and the rather erratic nature of the equity curve here is when we don't use any portfolio risk management at all. So each trade is undertaken on its own merits, and there's individual position risk management such as 1% stop losses and so on. But each position in a particular asset has no awareness of the other positions that are open at the time, and there's no risk calculation done across that entire portfolio. And then on the right, we have exactly the same strategy with the same rules, but this time incorporating portfolio risk management. And the specific actions that are being taken here is that position sizing is adjusted to accommodate the level of risk, and in some cases certain trades will be avoided entirely. And this tends to be the case when, for example, there's a proposed trade which is already highly correlated with the existing portfolio of positions, and so the excessive risk that that would cause means that the trade gets ignored. So let's now start to take a look at the portfolio risk calculations. This is the formula that we're already aware of because we've covered this in previous episodes, and this is for a single position. So the value at risk for that position is the Z-score multiplied by the standard deviation of the position multiplied by the amount invested in that position as a monetary value. Now, if this is the first video that you've seen in the series, then I would advise you to watch previous episodes so that this makes sense as I go through this in a lot of detail and explain exactly why and how this formula works. And if you want to access those episodes, if you look in the description right below the video, you'll see a link to the entire playlist. And so you'll see all of the episodes there in order. But assuming now you are familiar with this, let's now move on to the value at risk formula, this time for a portfolio of multiple positions. Now, on the face of it, this looks very similar. However, the detail behind it is actually fairly significantly different. So let's just quickly go through this one section at a time. First of all, the Z-score is just the Z-score. So as we know, this is a constant that determines the confidence level that we're looking at, and the value that we've been using up until this point for the Z-score is 1.65, which gives us that worst 5% of risk, or the 1 in 20. And there's no change for the portfolio calculation whatsoever. Next, if we take a look at the amount invested, this is fairly simple. So instead of the monetary amount invested in the position, here we calculate the sum of all of the monetary values across all of the positions. And it's as simple as that. The main difference is in the calculation of the standard deviation for the portfolio, because here we have to take into consideration the weightings of each of the positions, but more importantly, the correlation between them, because this significantly impacts the risk of the portfolio. And this is what the calculation for the portfolio standard deviation looks like. Now, it does look fairly complex, but bear with this because I'll be showing examples in the future in Excel and also code to help fully with the understanding behind it. So I think it's worthwhile working through each of the main variables that make up this formula. And whenever you see a W in this equation, it relates to the relative weight of a position. So W1 is the relative weight of position 1, W2 that of position 2. And these appear in each of the three main terms. The first two, the value gets squared, and the second one is the product of the weightings of each of the positions. Now the key thing here is that all of the weightings must add up to 1 in order for this formula to work. And the best way to do this is based on the relative monetary values, not the lot size, because the significance of lot sizes varies across different assets. So we have to focus on those monetary values that I went through how to calculate in previous episodes. The next variables I want to look at are the standard deviations of the individual positions. And so we see these again in all three terms. Now, if you've seen those previous episodes, you'll already be familiar with how to calculate this, because it's exactly the same as we calculated previously for a single position. It's just that now we're combining those individual values from multiple positions. And then the really key component here is the correlation between the two positions. And we see this in the formula here. And really, it's this term that determines the diversification of your portfolio. If you've chosen two positions that are highly correlated and tend to move together, then diversification will be very low. If, however, you have two positions with a low level of correlation, or even a negative correlation, then this helps to produce a diversified portfolio. And there are many major benefits of taking that approach in terms of lowering risk. And we'll see examples of this in future episodes. But for now, let's just use a few extreme examples of the different values that the correlation can take. As you're probably aware, this ranges from +1 all the way down through 0 to -1. And a value of +1 means that the two positions are perfectly correlated. So if one position moves up, so does the other. When the other moves down, so does the other. And so there are really no diversification benefits here at all. And if you think with the maximum value of 1, this third term here has its maximum value overall. And so the effect that that has is by giving you a large standard deviation for your portfolio. Or in other words, high volatility, high risk. Let's now look at the scenario where there is no correlation. So in this case, you can't actually predict what one position will do by knowing what the other position will do. Sometimes they'll go in the same direction, sometimes they'll go in opposite directions. It will be completely uncorrelated or random in nature. Now here, the third term completely disappears because we're multiplying the third term by 0. And so now we're just left with those first two terms. So clearly here, the standard deviation and the risk is going to be lower. And then going right the way to the other end of the spectrum and looking at a value of -1 for the correlation, this means they are completely negatively correlated, so if one position goes up, the other position will always go down, and vice versa. And so now the third term will have a negative value. So it will actually subtract a value from the sum of the first two terms. And so this is when we get our minimum value for the portfolio standard deviation, and therefore the minimum amount of risk. Now, these are clearly just example values for the correlation, and in reality, the actual values will lie somewhere between 1 and -1. But hopefully that illustrates how the correlation coefficient here affects the risk. Now, this will all seem a lot more real when we get to the next episode, where we're going to look at an example of this calculation in practice in Excel. And I'll try different values in here, different assets, and this will really illustrate the power and the potential of a diversified portfolio. Then in the episode that follows that, we make this even more real and start to code the value at risk for two positions in the MQL5 programming language. Now, please do remember to give me a thumbs up if you've got value from today. If the next episode's already available, you'll see it top right now. But now until next time, trade safe.